Hello and welcome back to the Market Lens. With summer now in full swing, I hope everyone out there has had some time to work on their tan. I'm Sam Rozzi, manager of Due Diligence, and I'm joined by Cliff Walsh, American Portfolio's Chief Investment Officer. We are now on the 9th edition of the Market Lens. If you've missed any prior episodes, please check them out in the Studio 454 video library or YouTube. Let's begin the show with our take on current trends, our news or noise section, COVID variants. As vaccination numbers continue to rise, we've seen a strong reopening of the economy, and we've seen a large resurgence in the U.S. consumer. We're now starting to hear louder rumblings on the rise of new COVID variants. The most well-known is the Delta variant from Europe, but there's an even newer one out of Peru, Lambda. I've heard some talks about mask mandates in the U.S., travel restrictions, and even lockdowns abroad. Do you think this is news or noise?
I think it's a little bit of both, actually. I don't think COVID-19 is going away anytime soon, but we've learned to mitigate the risks. I don't think we should lock down the economy every time there's a spike in new cases or a new variant emerges. From a personal perspective, people who are vaccinated, I think it's probably noise. For those who are unvaccinated, particularly those with comorbidities, there is a newsworthy risk. From an economic standpoint, I think you could see concerns grow about economic reopening activity.
Yeah, I feel like markets have moved on from the reopening on or reopening off trade to reflation on and reflation off mode. We're now seeing a pullback in the reflation trade. Do you think this is because of COVID concerns?
Is it enough of risk to impact the markets? Maybe, but I think less so in the US than in Europe or other international markets where the Pfizer and Moderna vaccine technology is less prevalent. We've seen profit taking. Airline stocks are down 16% from the recent highs. Casinos and gaming stocks are off 14%. Hotels, resorts, cruises down 8%. I would argue it's just as much about profit taking and value versus growth as long duration bonds have rallied, making the earning streams of growth companies more valuable.
Okay, so why do you think it'll have a muted impact?
The good news about all this is that while case numbers are rising and the Delta variant appears highly contagious, the link between cases and hospitalizations and deaths appears to be broken. So the consequences of COVID-19 are seemingly lower with Delta. Unless we see those consequences rise significantly with this new variant or another in the future, the pressure for a return to normalcy is too strong for the rise in Delta to hurt economic activity on a broad scale. Will it impact travel and entertainment spending? Yes. Will it impact overseas earnings from U.S. multinationals? Probably, but at this point, I think it's negligible.
So you believe that every business and every consumer will go back to operating the way they did prior to the pandemic?
No, absolutely not. DoorDash isn't going away. Grocery delivery isn't going away. They're too convenient. U.S. businesses may reshore manufacturing to reduce the impact of disruptions. Automation is going to accelerate. One, from companies who are afraid they'll be forced to shut down, and two, from those who are struggling to find low-wage workers because the government is paying them more in unemployment. We'll save the rising minimum wage discussion for another day, but that has the same impact as well. So consumers will act differently, new business models and trends will emerge, but change is different than a macro negative impact. I see that as less likely in the US, more likely abroad. Regardless, there are investment themes and trends that will work even if the broader economy feels pressure or the stock market does.
Understood. The Delta variant is now a known risk, so are interest rate hikes. Let's zoom in on under-the-radar risks. The S&P 500 has hit new highs more than 30 times this year. What could surprise markets from a negative standpoint?
I would point to China for two reasons, and they amplify each other, neither COVID related. First, economic growth has disappeared. They are not in contraction at this point, but this is an economy that typically grows at 4%, and those are forecasts because it's well known their 6% stated rate is inaccurate. We saw recently their services PMI implied growth slowed significantly in June, although it did remain above 50. China's General Services Business Activity Index fell by nearly 5 points to 50.3 in June, the largest single-month decline outside of February 2020. The New Business Index fell to 50.5 from 54.7 in May, while the new export business sub-index has been teetering back and forth between growth and contraction over the past few months. New hiring slowed notably to below 50. The employment sub-index was 49 in June versus 52.5 in May. Second is China's credit market. China's credit impulse, which captures new lending relative to GDP growth, has peaked and rolled over since the beginning of the year, down in 5 of the past 6 months and contracting on a year-over-year basis by the most since February 2019. China's been having a quiet battle with the bond default cycle within the state-owned enterprise sector. China's credit market is $17 trillion and it's on shaky ground. Bond yields for the weakest state-owned enterprises have risen 150 basis points in the past year to over 5%, and the political appetite for bailouts appears weak. At the very least, tighter financial conditions will suppress growth. Worst case is that profit declines put substantial pressure on the credit sector. An economically weak China is not good for global growth. A credit crisis could set off a negative chain of events.
Interesting. Any other areas that investors should be watching here?
Fed tightening. I'm not talking about interest rate hikes. I think those are years off. I'm talking about balance sheet reductions and tapering. It's just starting to make its way into the conversation after the last Fed meeting. Some are talking of tapering beginning by the end of this year, but I'm wondering if it's happening already. Take a look at the surge in reverse repo activity. The price of risk assets is highly dependent on the continuing positive inflows of bank reserves into the financial system, so the reduction of bank reserves poses market risk. Reverse repos take liquidity out of the financial system and have been used by the Federal Reserve as one way to tighten monetary policy. It's important because there is a high correlation of reverse repo activity to the VIX and negative correlation to the S&P. It does take some time for it to work through the system, so investors have to be on the lookout for it. It's possible this could trigger a repeat of the taper tantrum. My guess is that it won't last long, but the reaction could be meaningful. I think the Fed would back off quickly as it seems to listen to the market when its activities have a negative effect, so it could be an opportunity to take some profit in treasuries and perhaps add to equity exposure if we see a sizable response from the financial markets.
Thank you, Cliff. That wraps up today's Market Lens, and we hope this is letting you see 2020. We also hope everyone continues to enjoy the sunshine. I know I'll be doing some golfing and body surfing, so see everyone next time.